Good morning, Jags. This is Fahad. Today is Friday, August 21st. It's the expiration day for August. Let's get started. This is the 5-day S&P futures chart in front of you. And what I'm watching over here is that yesterday we printed the high of 3395, which on a daily scale was pretty much where the pre-COVID levels were. And now going back to that 5-day chart, you can see that we made a recovery after we pulled back when those FOMC minutes came out on Wednesday. And then on Thursday, we rallied back, did not take out the 3395 level in the S&P futures. And then within the past hour or so, we're selling off and we're basically right back down to near the lows that we saw in the S&P futures after those FOMC minutes came out. And if you look closely in this 5-day chart, you may notice that there have been other occasions of dramatic pullbacks in the market, spikes down, which then were, market did come back on a lighter volume, but then followed by, more spikes down. So there was one that happened here. This was on Friday last week, and then similarly we saw same thing on Monday. We saw that on Tuesday. We saw that on Wednesday, and it looks like we're seeing that again. Another thing I want to just point out, and this goes along with the discussion that I had a couple of days ago in conversations, because it's important to look at these market internals and if they're telling us anything. And my concern here is that when you look at the NIMO indicator, which is one of our favorite indicators, even though the S&P has gradually climbed the wall of worry and continued to go higher and higher, NIMO has corrected from a positive 38 reading about 5 to 6 days ago to close at a minus 35 reading yesterday. And NIMO is an oscillator that is an internal reading that tells us whether the participation is broad or the participation is weakening underneath the market, which is not easy to see by simply looking at the overall index. NIMO has been deteriorating for the past 4 to 5 days, or more like 10 days, while the S&P has continued to go up. And as you know, Avo has pointed out to me multiple times, as he watches these data points very closely, is that closing at minus 35 yesterday, but it's the level from this point, from minus 40 to minus 80, is when the panics gets more sharper and bigger. The accelerating sell-off could potentially happen unless we start to get immediate bounces back. Similarly, another reading that I pointed out previously is the accumulation index of this, which is the summation index of NIMO, called NYSE. And NYSE is giving us a bear cross now as well, where NYSE yesterday broke down below its 8-day moving average. And generally when that happens, when this black line takes out the red line, and all of these indicators, by the way, are provided in the first read each day, this is where, this is a clear confirmation of a potential breakdown in the S&P or a break in the momentum, at least in short term. Now, sometimes this happens only for a week or 2 weeks. You get a modest pullback in the market, and then we see a bounce back right away, like you can see the zigzag patterns. And other times, sometimes in extreme cases, this could prolong. This could go on for a month or 2 months, in which case you get much sharper pullbacks in the market that could result into 5-10% or even more percent pullback. And now, if you, on this S&P chart, if you actually layer, which I don't have, if you layer the short-term moving averages also as a proxy for the momentum indicators, if you look at the 7-day or the 20-day or the 21-day moving averages, and then if you see if we're starting to break down through those short-term moving averages as well, then I think it's going to open more eyes of the technicians around us, and they're going to say, okay, there's definitely a risk-off event that's coming. So that's another thing to keep in mind. Lastly, I will also point out, given looking at some of these other indicators, that the percentage of stocks in the New York Stock Exchange that are trading above their 50-day moving averages, they also topped out at the same exact time when NIMO topped out. About 5 to 6 days ago, we hit a peak of 79% of the stocks trading above 50-day. and now that reading has come down to 70%. So again, this is telling you that there has been some deterioration underneath, even though the S&P as a broad market has gone up, mainly led by these large cap tech stocks that continue to mask weakness underneath the market. Or if you look at the same reading, but on the S&P 500 side, which is the percentage of stocks in the S&P 500 index that are trading above their 50-day moving average, that topped out around 83% about 10 days ago and has seen a dramatic move down to 68%. Now, you know that S&P 500 index is basically all large cap tech stocks. So this has nothing to do with small caps, deteriorating underneath or mid caps deteriorating. This is S&P 500 index. So within the S&P 500 index, we have seen a fairly good percentage of the stocks move below their 50-day, which is just another indication of, basically distribution taking place underneath the market, while the large cap tech stocks keep things in check at the top of the funnel. Then I also mentioned a couple of days ago in the chat room that US dollar was the major proxy for the market rally, because as the Federal Reserve continued to pump money into the liquidity measures into the economy, and on top of it, or into the market, I should say, and then on top of it, we had all of these congressional funds, stimulus packages that were flowing in, which included the $1,200 checks and the $600 per week and many other things that continued to push the US dollar index down. And when the US dollar index is down, it's really good for multinationals. And as a result, those were the ones that kept the market higher. Well, that's also starting to reverse. You can see the US dollar index. We pointed out 2 days ago that we saw a major spike in the US dollar. As it got so oversold, we saw a big rally, counter rally. And now today, again, we are seeing a major counter rally in US dollar index. So this may have potentially more to come. And all those liquidity measures, for whether they came from Congress or they came from the Federal Reserve, they have sort of stalled, right? So the Federal Reserve has actually pulled back, has cut back on its quantitative easing program. There's no new program in play. We may hear something today about yield curve controls, but they gave us a little bit idea on that a couple of days ago, that there may be some resistance against it. And then also, no stimulus is being able to pass by Congress. So the US dollar is starting to get a bit, and that's also something telling you about potential risk-off event. And then the last thing, I will just show one more chart at it, which is the CBOE equity over put over call ratio. The red line, the 10-day moving average, continues to be extremely depressed, which means people are simply not protected out there. There's nobody's really hedging these markets. We are at a level where 0.46 is an extremely low level, which is where we closed yesterday. And the 10-day moving average I'm talking about here, this is just extremely low. Simply nobody's protecting portfolios out there. Not much hedging going on, not much put buying going on. So, and then lastly, you can see that even the VIX is no longer responding, is starting to stabilize. So, and then you combine these views with the simple fact that as I keep mentioning, that equity market seasonality does get weak in September and October month, and we're almost there, right? And so plus election risk on top of it. So you know what? Just keep all of this in mind. You can play the technical breakouts. We point them out when we see them, and they last sometimes immediate, for a week or 2 weeks. Sometimes they last only for a day or 2 days, and then you start to see some fading action. You can play those technical breakouts, but as I mentioned in webinar yesterday too, these readings are important to watch, because market takes stairs ups and elevator down, and if we're going to go into the risk-off environment at some point, it could be vicious. It could be pretty fast. So, and that's all I'm going to touch upon today, just on these market internal readings. And that's it from me. Jay?
Morning, everyone. So today I want to talk about a recent IPO that debuted last month. Company is called RNLX AI. The ticker is RNLX. Now, I plan to actually do a full write-up this weekend in Weekend Research, so keep an eye out for that. But who is this company? It's a medtech diagnostics company that offers a commercial product called Kidney Intel X, which uses a machine learning algorithm to combine artificial intelligence, biomarkers, and patient health records to provide patient prognosis and management of chronic kidney disease. Now, let me just quickly show you what a patient would get from this product. So one of the things that I know, Fahad, you always ask is, with a company, what stands out, what is special about them? Do they have anything that's proprietary? Now, according to some initiation notes that I've read, first of all, the test that they use, it uses 2 proprietary blood-based biomarkers. And then once that's complete, their AI algorithm kicks in. And that includes the personalized patient data from EHR systems such as age, weight, blood pressure. And this represents a key proprietary aspect of the company's capabilities. Now, equally important is the access to and the history with patient data. The company believes that any company attempting to create this test or model would struggle with the ability to use patient information that is critical to the predictive performance of the test. So, once again, I'll talk more about this in the weekend research. But one of the reasons that it kind of caught my attention today was because the company announced a partnership for their Kidney Intel X product with AstraZeneca. So AstraZeneca is going to use this test to optimize multiple therapies for diabetic kidney disease, chronic kidney disease, as well as other disease areas such as cardiovascular and metabolic disorders. According to Stifel, in their note today, they say that the partnership will be revenue generating this fiscal year, with results from stage 1 of the program expected in early 2021. And this is actually the second pharma relationship the company has been able to land. The first one happened approximately 6 weeks ago with a quote unquote unnamed top 10 global pharma company. So all of this in Stifel's view represents a good point of validation for the company and its product.
Excellent stuff. Something new again. Never heard of this naturally because this is a rather fresh IPO. I wonder what kind of how big is the market for this thing, and what kind of adoption rate we're expected to see as this company tests these tests, sell these tests and these processes. So, and if these relationships that they're building with large pharmaceutical companies and potentially lab testings and all of that, is the penetration very low? Is going to rise dramatically, and over how long of a period, and what the competitive landscape looks like? So all those kind of things, particularly how big the market is for this kind of stuff. So that will give us a color exactly what the opportunity is ahead. And interesting, looking forward to the write-up this weekend in the weekend research. Great stuff. Chronicle.
Morning, Fahad. I sent you some slides this morning. I don't know if you got them.
Yep, I have them open.
All right, so I have a short idea this morning. So I think it was early last month when I recommended to short Children's Place, symbol PLCE. While that has worked out very nicely and there's probably a bit more downside to go, the chart is starting to approach a strong support level, and so we might want to start looking into rotating that position into other names. And this morning, I'm looking at Urban Outfitters, symbol URBN. KeyBank was out with a note on the back to school theme regarding how the largest public school districts in the US are currently operating online while colleges are shifting back to online classes. According to their checks, about 50% of districts representing 68% of students are starting off with full remote learning, and they're expecting more announcements from universities to move to remote only. And KeyBank here is saying that Urban Outfitters and Under Armour are the most levered to back to school theme. Urban especially because they have 28% of sales occurring between July to September. And if we look at the first slide that I shared, They think that Urban is the most at risk here, followed by Under Armour, as we can see from the 3 highlighted columns. Now, if we go to the next slide, this next table shows KeyBank's latest weekly channel checks, which show that softline spend has begun to decelerate this month. And again, if we look at Urban Outfitters, which I've highlighted here, they're seeing deceleration for the past couple of weeks, and we still have several weeks to go for the back to school period. So this is looking bad for the company. And on the final slide, this has nothing to do with Urban Outfitters, but I just wanted to share this one because when I first talked about Children's Place last month, I mentioned that at some point we're going to see a slowdown in online discretionary retail. Just because e-commerce adoption has been growing doesn't mean we're not going to see slowing on the discretionary side. Because whether or not we're buying things online, people can only buy so many clothes or electronics before they have to take a break from all that discretionary buying. And Congress is still working on stimulus. And so this chart here is a reflection of that deceleration. And frankly, I don't see reacceleration happening until maybe Thanksgiving. But getting back to URBN, if we look at the price chart, this stock has recently rallied a bit, but we can see that every time it's tried to rally, the market just beats it back down. And so I think we can revisit around $16 here, which would be my immediate target. Not a bad return considering we're in a bull market. And lastly, another thing is over the course of our morning conversations next week, I'm planning to provide an update on any outstanding long and short recommendations on Jaguar Media. So if anyone has questions regarding any of those, like BHP, BCH, UPS, REXR, OZK, and so on, they can either send an email directly or type a question during Jaguar Live, and I'll do my best to factor them in to my updates next week.
Quickly on Children's Place, that was a great short recommendation, and it's been steadily breaking down for the last couple of days, and having moved down from 28 to 21 in just last 3 days on rather heavy volume as well. This is probably going to go and retest those March lows. Maybe not that as low as March low, that was a panic low, but I think that maybe mid-teens is probably where it's heading over time. And so on the urban side, this is a very interesting one as well, because it reminded me when I was going to Michigan State a long time ago, naturally, and right on the campus, across from the main campus on the main road, the very active road where all the students hung out all the time, there was this Urban Outfitter, a giant store where all the kids shopped at. And you're absolutely right. The Abercrombie and Fitch and Urban Outfitter and many of these kind of stores are so much tailored to the youth, particularly strategically located around campuses and spots where a lot of them hang out as well. And naturally, if we're going to start to see a lot of online classes with these universities becoming ghost town in the fall semester, that could be negative, particularly in the absence of a stimulus. So interesting look on this one. Let's see if this starts to pull back. And last thing I want to mention is that this chart is a this table from KeyBank is a very interesting look, because this is indeed highlighting a trend that is in fact possibly the worst trend that we have seen for a lot of these retailers or specialty retailers as the stimulus package rolls off. I think that there's something to be said that first they saw the surge because if their online presence basically took a major leg higher as the brick and mortars were closed, and secondly, the stimulus was flowing in nice and easy at that time, but there's a lot of red appearing over here. So interesting observations here from Grubhub and even Walmart, HelloFresh, Nordstrom, Peloton, even Wayfair, Lululemon down to 32% growth from where it has been in the past, maybe, and that stock has been on a tear for quite some time. So there is indeed a lot of redness that is appearing over here, and that's something to keep in mind. Similarly on this one as well, Abercrombie, Foot Locker, Nike, all of them. Let's see if this starts to translate into some more red shoots to the downside in some of these specialty retailers. So I'll be watching the sector very closely. Great stuff. Avo?
Looking at Brown-Forman, yesterday there was a bullish trader that closed off September. I should bring it up, not rely on my memory at 8 o'clock in the morning. Anyway, rolled out the 900 September 70 calls to March 75 calls, which are reflected in open interest this morning. I tried to get some more recent channel checks before they report. I think September 2nd-ish. I didn't find anything last night in my notes. There was a update on off-premise alcohol sales. The last one that I found was the last update I found was June 30th, which showed that in the previous 16 weeks leading up to June 30th, total alcohol beverage sales were up 26% year over year. Now, mind you, this is Nielsen data, so it could be a little inaccurate, but it's the only thing I could find. Spirits were up 35%, wine was up 29%, and this was all led by hard seltzer sales, which were up 230% just week over week at that point. Now, Brown-Forman doesn't sell hard seltzer, but it does sell spirits, hard liquor. And looking at their last earnings conference call, they did mention that despite all the issues that there was earlier this year, they did see a lot of sales, especially in Germany. They had good sales in Jack Daniels, reaching 1.5 million cases. And what else was there I was going to mention? Oh yeah, the company, I mean, despite all its issues, tariff-related problems, especially with Europe and everything else going on. I mean, look at this chart. We're sitting at home drinking, I guess that's what's going on. So if you guys see any channel checks that my system doesn't pick up, just plug it in there. But this looks pretty good to me.
NABC
I know you
data
like the Diageo instead of this, but
I
didn't
like
see
both.
anything on Diageo.
And depending, I mean, if you ask me from a drinking standpoint, I would rather choose bourbon over over scotch, but that's just me.
Yeah.
But anyways, the channel checks have been strong, but I think that there is something to be said about the decelerating trends, even in this particular category. But I think the optically there is strong. So, for example, I'm looking at the data for Brown-Forman. The 52-week change year over year was, in terms of total dollar sales, was up 17.6%. But in the last 12 weeks, so not the 52 weeks, just look at the last 12-week change year over year, was 28.2%. So material acceleration in the more recent 3 weeks than in the last in most recent 3 months, I should say, than the last 12 months. And so that naturally should translate into strong earnings. And I think the stock is also reflecting that. And I think some of this has to do as the travel came back, because a lot of this is sold on, through the duty-free shops, through travel locations, which was shut down materially, right? And so many of this basically starting to come back. So that is a big help as well. Plus, I think that there's also some innovative product launches that have happened, which I was reading about not too long ago. And so there's definitely trends that are positive over here. But what you want to keep an eye out is that there's going to be an NABCA checks that should be out there or should be coming soon, which is basically the National Alcohol Beverage Corporation, whatever. It puts together checks of, I believe, 25 states, the control states they call it, where they do have the data available from, and they look at it, and it becomes a nice proxy to see what's happening through the rest of the country, and they tell you exactly how much consumption trends have been in each state and such, and so that's the much more accurate data than Nielsen data has been in the past for us. So keep an eye on this. I like the chart, and interesting to note that the bull is not quitting. They roll those call options out to March 75 strike. So naturally they want more time, but they continue to see more upside in the stock. We'll keep an eye on this one.
And the
All right,
company
gents.
continues to pay out dividends, which is always a bonus for those looking for that.
Yeah. All right, everybody. Thank you very much for joining and have a great weekend. We'll see you next week.